A very good morning to all, and I'm very happy to see such a big turnout today on a Saturday morning. I think you could be doing something else or be in a golf course, but I think you take a time to come here. I'm sure you are very excited to invest in this sector. Thank you for John Lim for the opening address and giving such a good insight and overview. He probably took up half of my slides already. So I wouldn't need to really explain too much. Thank you also for share investors and REITers for inviting Keppel REIT and other REITs itself to share our views on the market itself. So without further ado, as introduced, my name is Wah San, and I'm for Keppel REIT, and it's my pleasure this morning basically to go through the s-REIT sector, giving you a little bit more on the key drivers, fundamentals of a REIT, and also, of course, talk a little bit more on the Keppel REIT, the office sector. Like what Leon said itself, you are also probably advised that what I said is not a representation to you to buy REITs. Each comes with its risk, and that you are probably better advised to do your own assessment and get your financial advisors. Singapore REIT sector. I think you have heard this more than once itself, that we have about 13 years history, and so far we have actually, inclusive of all the business trusts, we have 40 real estate investment REITs, as well as a business trust. Early on you heard about the 26 of them. True Blue REITs are about 26 of them. And total capitalization is about 70 billion. And generally, I think you would have heard that it covers about 6 categories: the office, hospitality, healthcare, and residential, industrial, retail, and of course, the general group of business trusts. This, you have seen them. And for the office sector, which I'm focusing on, there are generally 6 main office REITs in Singapore, and total asset under management of about 15 billion. And the assets that comes under this REITs itself come from, of course, mainly Singapore. And I think several of us are actually also exposed in Australia. There are some in Germany, China, and Hong Kong. Keppel REIT, for example, we are invested more skewed towards Singapore. We have almost 90% in Singapore and about just about slightly over 10% in Australian key cities. Before I go into the details itself, probably I just would do well to give you a general office market of Singapore, so that you have a better appreciation when I talk about what are the underpinning of a office REIT in Singapore. From the 3-year records that CBR has been tracking itself, Singapore Grade A office market has been performing very well in the last 3 years. The current occupancy is about 96.1%. And the rental rates itself has been running high. As you see from the graph itself, it was actually from ranging between 955 per square feet to about 1140. So you can see, actually, if you are investing in a REIT itself, you are enjoying the rental that underpins the REIT that you are investing. Of course, the office market is also underpinned by the general economy of Singapore. And last year, Singapore overall we achieved a GDP growth of about 2.9%, close to 3%. And this year, the forecast is that we will be kept in the range of 2 to 4%. So in essence itself, the office market is still healthy, or rather the economy is healthy, and the derived benefit of the office is also healthy. Okay. I will not touch, due to time constraint, I will not touch on Australian market. As I said, our exposure is just about 10%. Now, maybe I would like to share with you, which I think earlier on John also have touched broadly, what are the key performance indicators that will underpin an office REIT. First of all, I think not all REITs are the same. Some are pure play office and some has a combination of some retail in it. And therefore, when you want to pick your, even in office REIT itself, look a little bit deeper in itself, what does the constituent itself. The type of the properties, are they very new? Are they very old that requires a lot of upgrade, or there's actually opportunities to do a revamp? Yeah, the location is definitely also very important. Location says it well. When the market turns or when headwind comes itself, location will provide a very good shore for your value. Yeah, the quality of assets, which I just earlier on said itself. Then the number of assets in each of these REITs itself, you need to be also be aware of. Some REITs are just only have three, say for example, three assets itself. So three assets, if two of them are only income producing, one is still under the development, you'll find that your income stream may not be that smooth and not regular. Okay. Then, of course, last one, the geographical original diversification, as Mr. John Lim had just earlier on said. Are you all focused on only one market, or you are actually spread out in Hong Kong, Germany, China? Yeah. So this, when you are more spread out itself, that inherently you are importing also more risk into the asset. Okay. The next probably you need to be looking into will be the lease fundamentals itself. The assets that is held under this particular REIT itself, are they fully occupied, or are there a lot of vacancies? Vacancy doesn't mean bad thing. Vacancy in a improving market, in fact, spells a lot of opportunities. Yeah. And full occupancy, you need to know whether these occupancies are stable, whether they are short with long leases, or they are actually just going to be all expiring very soon. Okay, so in most of the office REITs itself, we will track all this occupancy expiring profile. We like to call the thing weighted average lease expiry, which gives you an indication of, on the average itself, what are the whole portfolio, what are the average occupancy that will expire, that your income are being actually protected. So when a REIT says that you have your 10 best, 10 biggest tenants itself, is 40% of the portfolio, and the weighted average lease expiry is 9 years. What it means is that it has 9 years of secured income or lease rentals for that 9 years for the group of tenants. I hope I'm not going too deep in itself. I think John has given you the overall. I try to give a little bit more detail. Okay. Of course, each REIT itself, you need to also take a look at its balance sheet strength, whether the asset itself is, the values are reasonable, whether it has overborrowing or it still have a lot of headroom, meaning that you can still borrow more. If you have actually a big asset base, but you have very little borrowing and you have a lot of cash, what it means is that it has a lot of firepower to take opportunities when the opportunities strike. Okay, and the other part itself, I think geographical diversification, I spoke about it itself. No, one more slide, sorry. Cash and cash equivalent, I saw the wrong slide, sorry. Cash and cash equivalent, I think I said it already. If you have cash, I think cash a lot of times is king, but cash uninvested is also a drag on the performance of the REIT. Cash should be deployed at the right opportunity. Okay. Next, the capital position. Whether if you are borrowed, I think all REITs itself, like early on explained itself, most of us have a gearing, meaning we borrow money also to help us to invest. And borrowing is not a bad thing. In fact, borrowing does help you to improve your returns. But if you borrow too much itself, do you have enough income to pay for the interest? So that is something that you should evaluate. When you look at the balance sheet itself, the interest rate cover, how many times does the income covers the interest rate that you have to pay each year? Or in interest rate, whether your interest rate are fixed or you have not hedged it, then you are open to market fluctuation, then you are actually added onto your portfolio interest rate risk. Debt maturity, are your banks itself knocking on your door the next year, the future year, or you have actually relationship with so many banks that your borrowings are all spread out in the next 5 to 10 years, then I think that speaks a lot of strength in that particular REIT. Credit rating, I think just spoken itself. Credit rating is an independent assurance that actually the fundamentals of the balance sheet of a REIT itself is sound. Okay. Unit holders return, frequency of the distribution yield, and the capital gain. Early on, I think it has also been spoken that I think you shouldn't be just looking at just the distribution yield. I think you should actually hold long term and aim for total return. That means there is capital appreciation opportunity. At the same time, I think you shouldn't be also comparing one REIT against another by just like you want to check on fixed deposit between bank A, bank B, bank C. You just go to the internet and say that everyone is almost the same, 1.2, 1.15, 1.3, and you picked on them. No. I think in terms of REITs itself, each REITs, the one that pays higher rates does not mean that it's performing better. It means that the fundamentals itself has its own risk itself, and therefore it is prepared to pay you that kind of returns. But over the long term, you should be concerned more about the total return. All right. Growth potential. I think having a good sponsor, having a good deal flow, meaning potential projects to assets to be injected into your REIT is important. Otherwise, your REIT will just stay on and the portfolio get older and older, and more so-called capital expenditure need to support the particular portfolio. So the need of refreshing and the opportunity to buy new ones and recycle some of your older properties are also a good measure of what the REIT is all about. And of course, how is the manager performing in optimizing the returns? Has he got a track record? Has he got a pedigree of good managers in terms of both office management as well as also capital management? Okay, now of course I would not do well if I do not cover Keppel REIT. Keppel REIT, it has a total of 4 billion market capitalization, meaning number of units out there multiplied by its price. And we have 12 office towers, spread over 9 premium assets. And as I said, we are in both Singapore and Australia. And to just appreciate the size itself, we have about 3 million square feet of office space, prime office space. And together itself, the total asset under management is 8.2 billion. We are one of the largest in the s-REIT sector. A little bit of background, how Keppel REIT has grown. We actually started off just about 9 years ago. We only had actually only 4 assets, and it started with a humble beginning of 630 million. And today, I earlier on said is that we have 8.2 billion. It's more than 13 times. Yeah. Today, we are proud to be probably one of the first to enter the Australian market more than 3 years ago. And those assets are prime. Later, I'll show you the picture of it itself. And how to share our growth story. Since then, the first humble beginning 9 years ago, we have actually renewed 3 of the older assets for newer. That's one of the strategy we grew. One of it itself, 2 examples. One of it itself is actually we swapped Keppel Towers and GE Towers with Marina Bay Financial Centre Phase 1, which comprises Tower 1 and Tower 2. Yeah, and that swapped a 20-year-old building, much older, requiring more capital expenditure and upgrading to a new asset. So these are ways that a REIT manager with a good sponsor is able to allow you to have this opportunity to improve the quality of the asset. Another transformation that we made was actually just only last year. We did also swap away Prudential Tower, and in exchange itself, we took up a 1/3 share of Tower 3 of Marina Bay Financial Centre. So that brings us a total of all the 3 towers, and on a total portfolio itself, we have probably the youngest portfolio of assets in the office sector. So this is what we have now. We think that we are best in class in the prime office sector. And you can see that actually the choice of assets itself, we did tell you that location is most important. We have all our assets well connected to MRT and key nodes of transportation. In Australia, we didn't go anywhere, everywhere. We just pick on the major cities itself. We have 2 in Sydney, and 1 in Melbourne, and 1 in Perth, and 1 in Brisbane. So we have 5 assets in what? I think many of you have traveled down to Australia. I hope later on when you go out to see the brochures, you can actually see some of the assets, and so when you are down in Australia, you will be able to pick up which assets that Keppel REIT owns, and hopefully you can be one of the proud owners of one of these buildings. Okay, key highlights in the first quarter of 15. I think we are still performing very well. Unit holders distribution itself improved by about 18% quarter on quarter, and in terms of DPU, distribution per unit itself also increased 13% quarter on quarter, 1.7 cents per unit. Yep. And because of some of the leases that were signed long time ago itself, in first quarter itself, we saw a 19% positive rental reversion. These are things that I think actual performance, but when you evaluate a REIT itself, these are important things itself, whether there is opportunity that your current holding, property holding itself, is there any potential increase in rental? And for Keppel REIT itself, for first quarter 15, we saw a 19% for those leases that were expiring. We were able to get a traction of 19% positive return. Yeah, and we continue to maintain a high retention rate. Retention rate is another key performance that the manager does, meaning to be able to retain your tenants, that your tenants doesn't, the newest building that comes along itself, he moves away and you have a big vacancy and you have loss of income. So asset managers, REIT managers, one of the key performance itself is to be able to retain such tenants. Tenant diversification, not all put in one sector, but you can see from here itself, the biggest sector is the banking and finance. Reason being that they are the biggest paymaster, they can pay the highest rent. Yeah, and our office being all in the CBD, generally they will be the biggest sector. Whether there's risk and in having so many people of this in this sector itself, I think we see a lot of resilience. Banks do restructure, somebody will come in and that kind of thing. So we are very proud to say that most of our buildings are still maintaining almost 100 or near to 100% occupancy. So these are the, probably you identify with them itself, they are all really the true blue chip tenants that we have. Yeah, we are proud to have them, and these are the tenants that we will continue to cultivate and make sure that they will stay with us for a long, long time, and therefore pay us the rent, and we pay the unit holders the dividends. We have a small portion of retail which are actually supporting the office. An office that hasn't got any support function like eateries and whatever will be a little bit less attractive. So like our Marina Bay Financial Center is in the basement. There are about 60 over shops down there. Collection, a lady might break your heel itself, you could quickly pick up a pair of shoes. A man that need a tie to attend a meeting, I think you could just run down and what. And for lunchtime, of course, every food center is fully occupied. You can't find a chair. Yeah. All right, I think this was early on said also, but I'm just representing it in another way. Keppel DPU distribution per unit yield itself is at 5.7%. You compare it with property counters, you compare it with your CPF ordinary account savings, compare it with the so-called almost risk-free 10-year government bond itself, you can see that we are actually returning you a very decent, more than double what a government bond will be paying. But of course, like early on being advised, it comes with risk. It's not risk-free. Okay? So I think I continue to just basically give you a pictorial walkthrough on the cluster of assets that we have. Marina Bay Financial Center, there are 3 towers there with a shopping in the basement. Ocean Financial Center, I think at Raffles Place, is our pride, and it's just been, phase 2 just been completed. The whole building is 100% occupied. And I think it's probably one of the office buildings that has the big green wall. If you are down there at Raffles Place, you'll see a big green wall that depicts the map of Singapore as well as also Southeast Asia map. And to it is that we also throw in some art, very generous art pieces there. The basement has its own retail. One Raffles Quay, which we partly own, 1/3 share in it itself. And Bugis Junction, which is a 20-year-old building. Our office is there. Our parent company is also there. In Australia, very interesting building in Australia, in Sydney. This building just completed about 1.5 years ago. It has achieved win several awards. It's named just only last month, named as the best Australian development for the year. And it features, it's a very small site. It features a new concept called vertical village, where has used a lot of natural lightings. And I think the fins of the building, because it's facing the Sydney Harbour, when the sun comes in itself, the fins will be able to tilt at a certain angle according to the sun, and thereby reducing energy. 77 King Street, if you are down in King Street or George Street itself, where you see the Apple shop down there itself, that's what we own too. In Melbourne, we have this building built over the heritage building of Harold Sun, and proudly occupied by anchor tenant Ernst & Young. Yeah. And at Brisbane, we have 275 George Street. And of course, the last of the portfolio is to be completed probably in August, September. We would have one more building added into it. And this building is interesting in the sense that it's 100% leased to the Western Australian government for 25 years. So you'll be assured of a 25 years of smooth income from the Australian government. And it's not just a flat income, it's an annual built-in escalation. So this is the interesting, there are some that has volatility on vacancy, new people come in, some people may exit, but we construct a portfolio that is resilient enough. Some of these are 25 years leased to the government at the annual escalation. So my CEO is there, the partner CEO, as well as the Australian Minister of Finance. Yeah. So in conclusion, actually, we have the youngest portfolio of assets itself. You look through the skyline, even the same skyline that is presented here itself. If you are owner of Keppel REIT, you are a proud owner of several of this building. Okay. Thank you very much. And we have a booth just outside the door itself. I think probably at coffee break or later on during lunchtime itself. Please drop by. I will be there. Some of my colleagues will be there to entertain any of your questions. Thank you very much.